Ever wonder how Canada's wealthiest families pay for university and higher education? Here's what surprised me. They don't just write big checks. Instead, they use legal tax strategies that let them claim more government benefits than average families. I'm talking about strategies that can save tens of thousands in taxes while funding six-figure education costs. Today I'm breaking down 4 specific methods wealthy families use, including trusts and corporate structures that most people have never heard of. These aren't loopholes or gray areas. They're legitimate strategies that tax professionals recommend to their highest net worth clients. Hi, Kane again. I'm a theater grad that started with zero. 20 years later, I now own properties throughout Ontario. Also, please see the description below to see where I've pulled this information from. If there are any discrepancies, please let me know. Further, speak to your accountant and lawyer before setting up any legal structure or entity, as this video is solely for educational purposes only and not to provide any official accounting and legal advice. Without further ado, let's get started. The first strategy starts with something you probably think is meant for middle-class families. RESPs are that middle-class savings tool. If one starts looking into how billionaire families use them, they will find something different. The RESP gives you a 20% match on the first $2,500 you put in each year. That's $500 free money from the government, up to $7,200 total per child. You'd think rich families would skip this small government handout. After all, what's $7,200 to someone worth millions? Rich families also coordinate grandparent contributions. Multiple family members can contribute to the same child's RESP, but the government grants stay fixed at $500 per year and $7,200 lifetime per child. What these families do is coordinate contributions from parents, grandparents, and other relatives to hit the maximum $50,000 lifetime contribution limit as quickly as possible while securing all available grants. Some families have 5 or 6 adults all contributing to one child's education fund, making sure they captured every dollar available as long as they stay within the contribution limits. The tax benefits create the real savings. All investment growth inside the RESP grows without any tax burden. When the educational assistance payments come out to pay for education, they get taxed in the student's hands instead of the parent's high tax bracket. Since full-time students typically have income below the basic personal exemption and qualify for various education credits, they often pay little to no tax on these withdrawals. This tax shift mechanism becomes the main benefit for wealthy families beyond just the government grants. But please see your accountant for further information, as it's different for each individual. The best part is the timing. Rich families start these accounts when their kids are babies. They have 18 years for the money to grow tax-free. The investment growth that would have been heavily taxed in the parent's name gets shifted to the student's near zero tax rate. But wealthy families don't stop with RESPs. Once they've maxed out these government programs, they move to more sophisticated structures that create even bigger tax advantages. The family trust becomes their next tool. This is where the real tax magic happens, especially for business owners and entrepreneurs who operate through corporations. A family trust is a legal structure where parents put money in, but they can decide who gets the income each year. The trust becomes like a pool of money that can flow to any family member the parents choose. Here's the part that sounds too good to be true. The trust can pay out investment income to any family member, including adult children who are students. Let's see how this works with real numbers. A parent in the top tax bracket pays about 50% tax on investment income in most provinces. That same income paid to a student might be taxed at 0% to 20%, depending on their other income for the year. The math gets compelling fast. Say a high-income parent requires funding for education. Taking $30,000 in corporate dividends personally might result in $10,000 in tax at around 33.71%. By contrast, allocating $20,000 directly as dividend income through the trust to a student may result in $0 tax for the student. This yields approximately $10,000 in tax savings per year, totaling $40,000 over a 4-year degree. The trust files its own tax return and issues slips to whoever receives the money that year. Business owners have an extra advantage here. They can pay dividends to the trust, then allocate those dividends to adult children. Private corporations can distribute their profits as dividends instead of salary. When these dividends go to a trust, the trustees can split them between multiple beneficiaries. Each beneficiary uses their own tax brackets and personal tax credits. This strategy legally moves money from the parents' 50% tax bracket to the students' near zero bracket, creating massive annual savings. The trust can continue operating for decades, funding multiple children through their education years. Parents can adjust the distributions each year based on who needs money for school. The best part is combining this with the RESP strategy for a hybrid approach that maximizes both government grants and tax efficiency. Families use RESPs to capture free government money first, then use trusts to handle the remaining education costs with maximum tax savings. The annual $10,000 tax saving achievable through the trust mechanism is substantially greater than the maximum $500 annual Canada Education Savings Grant, confirming the trust is the superior vehicle for managing large costs. This creates a system where wealthy families pay less tax while funding education than average families pay on regular income. But business owners have access to an even more direct approach that takes this concept further. Business owners can pay their adult children directly from their company for education costs. When you own a private corporation, you can pay dividends to family members who are shareholders, including adult children. Most people think this sounds like tax evasion, but it's completely legal and encouraged by tax planners across Canada. The key is making adult children legitimate shareholders in the family business. This usually happens through the family trust structure we discussed earlier, or through direct ownership arrangements. The process requires proper legal documentation and following specific tax rules. Once they're shareholders, the company can pay them dividends for their education costs instead of the parent paying personally. The family trust becomes particularly useful here because it can hold shares in the corporation and then allocate dividend income discretionarily to the adult children as needed for education expenses. This creates a flexible system where the business owner maintains control while achieving maximum tax efficiency. Here's an example of how this might work. Again, speak to your accountant and lawyer for further information, as each person's situation is different. A parent taking money out of their company personally might pay high tax rates on that income, then use the after-tax amount for tuition. The same amount paid as dividends directly to an adult child student results in much lower total tax. The difference comes from the tax brackets and personal tax credits available to each person. The basic personal exemption in Canada is over $15,000, which means the first 15 of the student's income is completely tax-free. Students also get additional credits that reduce their tax even more. Business owners in high tax brackets don't get these same benefits when they take money out personally first. Families that save $15,000 to $20,000 per year just by changing who receives the dividend payments from their business. The savings add up over 4 years of university. One family saved significant taxes while funding their child's engineering degree. They used those savings to fund a down payment on the child's first home after graduation. The setup requires advanced planning. Adult children need to become shareholders before they start university, often through the family trust structure. The company needs to have enough retained earnings to pay dividends. Business owners also need to make sure they don't need all the company profits for their own living expenses. This income splitting mechanism shifts corporate dividends from the parent's high tax bracket to the student's low tax bracket. The corporation distributes profits as dividends to the trust, which then allocates them to the student beneficiaries. Each beneficiary uses their own tax brackets and personal tax credits. Corporate structures let business owners fund six-figure education costs while keeping money in the lowest possible brackets. These strategies create substantial advantages for families who understand the rules. But the real question becomes who actually benefits most from Canada's education system overall. Government data reveals who captures the most education benefits in Canada. All these programs were designed to help all Canadian families access education. RESPs, tax credits, tuition transfers were meant to level the playing field for all. Research shows that families in the top income brackets claim a much larger share of education-related tax benefits than everyone else. In 2015, families in the top 20% of earners received 37.7% of all non-refundable tax credits for tuition, textbook, and education expenses. That means the wealthiest fifth of Canadian families captured more than 1/3 of all education tax benefits. This pattern shows up across multiple programs. The Parliamentary Budget Officer study specifically notes that higher income households also capture a larger share of RESP benefits. They know how to maximize the government grants and tax-deferred growth features. They have the money to contribute the maximum amounts each year. They also have access to financial advisors who explain these strategies in detail. The system creates a cycle where knowledge equals savings. Wealthy families hire tax professionals who show them every available credit and deduction. Middle-class families often miss out on benefits they qualify for because they don't know the rules. Lower-income families might not have enough money to contribute to programs that require upfront investment. Tuition tax credits work the same way. Students must first use the credit to reduce their own tax payable to zero before they can transfer the remainder to parents or grandparents, up to a maximum of $5,000 annually, or carry it forward to future years. Wealthy families make sure they claim every dollar of available credits. They keep detailed records and file returns that capture all possible benefits. They also time their income and deductions to maximize the value of these transfers. The wealthy don't just use these strategies for their own benefit. Many create scholarship funds and bursaries that help other students too. Rich families establish named scholarship funds at universities. These funds support students based on academic merit or financial need. The families receive tax deductions for their charitable donations, which further enhances their overall net savings and creates a system where their financial support is also tax optimized. Some wealthy families create multiple scholarship programs across different schools. They might fund scholarships at their children's university and graduate programs. This creates a network effect where their family name becomes associated with education support. These scholarship programs often have criteria that their own children can meet. Merit-based awards don't consider family income. A wealthy student with good grades can win scholarships alongside students from lower-income families. The wealthy family gets to support education broadly while potentially benefiting their own children. The system rewards families who know how to navigate it. This creates an advantage that goes far beyond just having money to pay tuition. Knowledge of tax rules and program structures becomes as valuable as having cash in the bank. These sophisticated strategies show that the greatest leverage in education funding comes from tax planning, not collecting grants. RESPs, family trusts, and corporate dividend strategies create tax savings that can exceed the actual cost of tuition in some cases. These families treat education funding like any other investment decision. They focus on minimizing tax while maximizing government benefits through legal structures most people never learn about. If you own a business or have significant investments, speak to your accountant about education funding strategies for your family. The rules exist for everyone to use, but effective education funding relies on professional navigation of complex tools like trusts and corporate structures. If you'd enjoyed this content, be sure to watch my video about how to protect your family from a lawsuit up next.